Okay, next up here, I want to react to this video from September 2008. I think it's very important.
This is going to be one of the watershed days in financial markets history.
It was a manic Monday in the financial markets. The Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend. Lehman Brothers, a 158-year-old firm, filed for bankruptcy.
I don't think anyone really expected a bank as big as Lehman to, be in a position that it's in now.
Brought down by bad mortgage investments, Lehman, which has 25,000 employees, will be liquidated.
I'm starting to find another job.
Meanwhile, Merrill Lynch, fearing it could be next, agreed in an act of desperation to a shotgun marriage with Bank of America. Merrill, the country's biggest brokerage with 60,000 employees, had been battered by nearly $50 billion in mortgage-related losses.
It is definitely a very, very difficult time, and it's not going to get better quickly.
So in just 6 months, 3 of the 5 biggest independent firms on Wall Street have now disappeared. Bear Stearns, which collapsed last spring, Lehman Brothers, and Merrill Lynch.
3 of the 5 biggest Wall Street firms go under, in a matter of months. That's why, when people bring it back to, what's been happening recently in the market and the Trump tariffs and, that's like in 08, 09, I'm like, no. I'm like, all this stuff could be reversed in a day, as you're seeing right in front of you. Could be taken off. Oh, we're going to take this off. We're going to exempt this. We're going to take this off. Blah, blah, blah. This can all be fixed. That sort of insane event there is a one of a kind. I mean, we're getting numbers out of the big banks. You're seeing stuff like this. JP Morgan profit jumps 9%, tops Wall Street estimates. Net income of $14.6 billion. Net income, not revenue, net income of $14.6 billion. This is nothing. I mean, 0%. Like 08, 09, what's been happening here recently in the market. It couldn't be further from, honestly, that. If you go back to that sort of time period, 08, 09, these financial institutions were all of a sudden taking massive losses, and, 3 of the 5 biggest went under. That's a whole
Treasury
different
Secretary
dynamic.
Henry Paulson tried to reassure investors today.
The American people can remain confident in the soundness and the resilience of our financial system.
Paulson attempted to broker a deal to sell Lehman over the weekend, but unlike the buyout deal for Bear Stearns, the government would not offer any financial guarantees.
I never once considered that it was appropriate to put taxpayer money on the line in resolving Lehman Brothers.
It would have required an $85 billion subsidy to keep afloat. Overall, I estimate it's going to cost at least $400 billion if you wanted to bail out the whole bunch. They're certainly not worth it. It's better to let them fail.
Insurance giant AIG is the next name on the list of troubled companies. It's looking for $40 billion in bridge loans.
Some people say this doesn't stop until the housing hits bottom. Do you think that's true?
I think that's probably correct.
Veteran trader Art Cashin believes there could be more casualties.
This is the 5th time we've seen this movie. And you sit on the edge of your seat and you yell at whichever character it is, don't go into that woodshed. But they keep going in.
R.I.P. Art Cashin. Yeah, 100%, right? Oh, man, that's good stuff right there.
The Federal Reserve meets tomorrow. The expectation before the events of this past weekend was that the Fed would sit tight on interest rates. But now some are actually forecasting another Fed rate cut tomorrow. Katie?
And Anthony, I know individual investors don't have their money in Lehman Brothers. It's those big corporate institutions that are most directly impacted by the bankruptcy. So what will happen to the assets?
My mom used to love watching Katie Couric back in the day.
That are left?
Yeah, Lehman, Katie, actually has $600 billion worth of assets. Some of those profitable ones, and there are some, will get sold off. The others will get divided up in bankruptcy court, and that could take years. It's important to note here, Katie, that one reason the Fed and the Treasury did not inject government money in a deal to try to save Lehman was that they thought many of their clients had time to anticipate all this. Katie?
All right. Anthony Mason on Wall Street. Anthony, thank you.
So, yeah, I mean, a few things here. I mean, obviously, there's so many things different from what we've been going through recently versus an 08, 09, 50% crash, right? And just when you're through one, right? I mean, we're talking about the biggest financial institutions in the world failing one after one. We're talking financial institutions making so much money they don't know where to put it all, right? But you got to understand, back then, a lot of the biggest problems came back to over leverage, right? And over leverage in regards to real estate, could be over leverage in the stock market, like a lot of over leverage in a lot of different places, right? And so the thing that I would say we don't have right now is I would say we've gotten rid of a lot of the over leverage in the market. You're going to see margin amounts down several $100 billion, in my opinion. When you see the new numbers that will come out in about a month from now, 2 months from now, versus where they're at in January, we just got rid of a lot of excess margin. I almost guarantee you that. You'll see it in the numbers very shortly. Additionally, when it comes to real estate, I would say people are not over leveraged. We have no situation like that. It does not mean prices are fair or right, but at the end of the day, it's not my place to say what's a fair price for real estate versus what's not, right? Somebody in Manhattan's willing to pay, $10 million for a 3-bedroom condo, like they can go pay that. It's not my job to say if that's fair or not, right? Nor is it yours or anybody's, just to be quite frank. That's just the way it is, right? But in regards to real estate market, you have to worry if a lot of people are very highly over leveraged and they're speculating on real estate, buying, a ton of properties just because they believe they're going to go up over the next 6 to 12 months. We don't really see a lot of that in the market either. You've gotten a lot of the flippers have gotten kicked out of the market over the past 3 years. So you don't have a lot of speculation in real estate either. Like it's been like the flippers, because two of the markets I know best are one, my city, Las Vegas, and then I know Phoenix, Arizona very well. And in Las Vegas and Phoenix, those are two of the markets that you get the most flipping activity. Like you get a ton of people that love to come in and flip properties. I can tell you it's been a ghost town last 2 or 3 years in regards to home flippers. Like it's just not that sort of market. Home flippers want to flip homes in a market that's very active. A lot of people moving, a lot of people looking for homes, and lower interest rates. We don't have either one of those, which is why a lot of the flippers have just gone non-existent. They're not interested in this market because there's no money to be made. If you got hardly anybody willing to buy homes, right, there goes all your customer base. And if interest rates are very high, then for you to carry, that cost of capital is very expensive. And so if all of a sudden you flip a property, you improve it, make it really nice, and you try to sell it 3 months later, and then it sits on the market another 6 months, you just eroded a ton of your profits, if not all your profits, right? So we don't have a lot of speculation in real estate now. And like I said, in regards to stocks, a lot of that's kind of been unwound. As far as crypto goes, we still have gotten, a lot of that crypto speculation immensely off the books, really. Obviously 2022 was a painful year and a lot of the ones that were leveraged went under. So I look out there and I think it's a rather healthy environment when it comes to speculation, when it comes to leverage. I don't think we have massive leverage problems in the system right now. And so if you want to talk about an 08, 09, we had massive leverage problems, going into that mess. And that was a whole mess to deal with there. Additionally, the Fed comes back to the Fed, right? We got a Fed that's very quick to act. In my opinion, the Fed seems to, when the S&P 500 goes down around that 20 to 25% range, that's to me, kind of watching the Fed over the past 16 years, that seems to be the place when the Fed all of a sudden feels like they got to step up. Like if all of a sudden you can get the S&P down 20 to 25%, all of a sudden the Fed's like, okay, we're going to come in and backstop things. All the big dogs at the Fed, they start coming out in interviews saying they're willing to do whatever it takes to the market to make sure, we don't have systemic problems and all that stuff. Even this week, there's a certain Fed official, I can't remember which one, but one of the Fed officials came out and basically their tonality was around they'll do whatever it takes to, help the market if need be, right? And they're keeping a close eye on everything, which, goes back to the Fed's that backstop all the time, right? And so, that's a lot of factors you just didn't have back in 08, 09. 08, 09 was that opening to the Fed kind of really becoming very, very dominant. And really since that time period, the Fed's become much more dominant than they ever were before. The Fed always mattered. It's just since 08, 09, they've mattered to a much greater extent, right? All right, let's listen to BlackRock CEO Larry Fink.
A recession in the United States.
As I said on Monday in a talk that I gave at the New York Economic Club, I think we're very close, if not in a recession now. What may be...
You don't need that.
Good. What may be happening is a lot of people are buying in advance of the elevated increases, like lines around Apple stores buying iPhones and all that stuff. But I believe...
So this is fascinating. He's talking about lines around Apple stores, and then I'm like, is this real? And then Amit posted, about at the Apple store, this place is packed. Guess everyone's excited about no more tariffs. U.S. consumers were truly one of a kind. If this is true, and people are actually going out there and buying iPhones left and right because they're hearing all over TikTok and Instagram and YouTube and everywhere that, Facebook, you better go buy an iPhone because it's about to go up a bunch in price or something like that. It's just hilarious. Because that might actually help Apple beat numbers for this quarter when everybody thought they were for sure going to miss. Or actually, it would actually help for next quarter because they're already out of the last quarter because now we're in April. So it would actually help for next quarter. So imagine Apple has better guidance than everybody expects for next quarter because everybody's gone out to go buy iPhones and all this stuff now at this point in time. Oh, it just cracks me up, man. Cracks me up. You never know how these things will work out. But who knows, maybe Apple's numbers are even better for next quarter than people anticipated because of this stuff.
All the uncertainty is really making everyone pause. And everyone's wait and see. And so I think you're going to see them across the board. They just say slow down until we have more certainty. Yeah. And, we now have a 90-day pause on the reciprocal tariff. That means longer, more elevated uncertainty.
Speaking of pauses, let's take a quick pause. Let's get the opening bell. We'll be right back to Larry for a conversation. Here at the big board, we've got Project Hood, that's a Chicago-based nonprofit aiming to reduce violence, build economic opportunity at the Nasdaq, the online pet pharmacy, PetMeds. There's something you want to buy. Dog gets sick, man. You got trouble. No doubt about it. All right, Larry, let's continue. I know we got a little bit of background noise here, but you're making the point. You obviously talked about this. Listen, we were talking about it, the uncertainty. So many CEOs we're speaking to. I've heard this now many number of times, similar to early days of COVID, like 5 years ago. Sure. I just don't know what's coming. I have nothing to expect, and so I'm keeping my head down. Is that a fair way to sort of characterize it?
I think that's a bad answer because today you need to run into the uncertainty and try to find solutions. Okay. So keeping your head down, I would not like that as an answer as a shareholder with any CEO.
Right.
I mean, to me, this is an opportunity to look for opportunities. And because of all our clients having uncertainty, we are spending more time with more conversation with more clients globally than any time. Our job now is to be, helping, calming, giving them ideas. So if a CEO said, I'm going to keep my head down.
Well, I guess that was the way one characterized it. But I guess it's the uncertainty itself that creates an inability to do long-term planning in terms of capital allocation.
There's no question CapEx is falling right now until you have better understanding where should that CapEx go. But I do believe, as I said in my talk this morning, yes. I do believe the mega trends are still with us, whether it's AI, data centers, infrastructure, the whole reorientation of our economy. So I think the mega force trends are not going to change by what is happening now. But maybe the execution of some of these trends may be delayed, maybe pushed out longer. But I still remain to be optimistic over the long run. Yes, we have to recalibrate. Yes, I do believe we're probably starting, if not, we're in a recession. Yes, I think the market is still underestimating how high inflation can get. If you factor in all the tariffs,
right?
You factor in all these other issues, it's going to be quite additive. I mean, I read in a report that if you just take the tariffs in the cost of home building, the average new home could be up as much as 26%. We already have a housing affordability problem.
None of this sounds any good to me, Larry. And it's all self-inflicted, by the way. None of it needed to happen.
This is not a pandemic. This is not a financial crisis. This is something that we've created. As I said also on Monday, United States post.
Yeah, but that's the whole point that people were missing, and that haven't been buying the dip, especially this past week with these incredible opportunities the past couple of weeks, right? Is they missed the whole point about if it's self-inflicted, it could also not be self-inflicted, right? Like if I punch myself in the face and say, "Oh my gosh, you're causing so much damage," but if I just stop punching myself in the face, well, then the damage stops, right? And so. It's just fascinating to think everybody, Trump, they think they believe everything Trump says and does. And it's just with Trump it's a different individual, man. He's going to do and say a lot of things, and it doesn't mean you got to take him at his word. That's all I'll say about that.
World War II was a global stabilizer. We are the global destabilizer.
Right. Now,
And
Larry,
that's a very hard thing to say, because I pride ourselves of being, bringing the leadership, bringing the conversations. But I will say the power of U.S. capitalism is still alive. I will say more and more times clients worldwide are asking for our, at least at the CEO level, they're asking for our vision, our views. They still want to engage. They still want to build. So I'm long term, I'm less worried about some of these issues. But in the short run, I'm petrified at some of these issues.
Petrified.
Well, let's speak of being petrified. You and I are old enough to remember when Nixon went to China. Opened the door.
Or the gold, walking away from the gold standard.
Right, the same couple of years. And I think that there was tremendous anxiety then going the other way. Did we really think that we could have a great relationship with Mao, who was a mass murderer? Did we think that we could actually do business with China? We did $1 billion with them the next year. But then next thing we know, we're doing $100 billion. Now we're doing $438 billion.
Yes.
And now we want to do zero. How does zero impact our country?
Well, we've had now 20 plus years of supply chain creations. And another economic force, Jim, post-World War II was consumerism. So we built the whole foundation of economic policy around consumerism, providing Americans with the cheapest products. Right. And so that was the foundation. Now, did that come at a cost that some of our communities were decimated, where they lost jobs? Absolutely. So maybe we went too far on the whole concept of consumerism. But let's be clear, the major economic foundation was based on consumerism. And so we wanted our companies to go around the world to find the best places to provide the highest quality at the cheapest prices, so we could consume more. And we always thought that type of consumption was the most progressive form of economic behavior. More people could have more, and that was one of the fundamental reasons why the United States was the leader. Yes, because our citizens were huge consumers. By now changing this equilibrium, it's going to be harder to consume, and we're going to have elevated inflation.
Do we?
Yeah, I mean, at the end of the day, man, jobs come, jobs go. Like, that's just part of the system, right? When I started my real estate marketing business back in 2015, right, there was still a relatively newer concept in terms of hiring a professional photographer who just photos real estate properties, right? Go in and take properties, and I was doing the drone photography and videography as well, and that was insanely new. I was no one was really doing that. When I would go to people and show them my drone photos of properties, luxury homes and videos and things like that, people are blown away back then. It was crazy, right? Someday that's not even going to be a thing. You know what I mean? That job will be eliminated. Probably not this decade, right? There's going to be plenty more real estate photographers and drone photographers and things like that. But 50 years from now, there probably won't even be a need for somebody like that, right? The way technology will evolve, it won't even be a thing anymore. And so that's just jobs. That's just creation over time, right? Jobs come, jobs go, new opportunities exist. And for you as an individual, you got to find where the newer opportunities are, right? You got to find where that next opportunity is. Like I did when I started my real estate marketing business, and understanding, this is a big opportunity here, right? Hey, it's Jeremy. I hope you really enjoyed that clip here today. What you looking at in front of you right there? That's the 6-figure Hall of Fame. Do you want to see the next one? That's the 7-figure Hall of Fame. Now, that is my private group. Those are members of my private group that have scaled to 6 figures, multi-6 figures, 7 figures, multi-7 figures in their stock market portfolio. They say you are the average of the 5 people you associate with. If you're somebody that is having trouble finding other long-term investors that are focused on building their wealth over the coming years, finding like-minded folks, look no further than my private group. We got a tremendous amount of people. We're consistently talking with each other, learning from each other, researching companies together, sharing news about our different companies, right? We do all that inside my private group. If you would like to apply to join us in there, go down in the description area. There'll be an application down there. You can click on that and you can apply to join us in there and take your game up to a much higher level and associate with the type of folks that you actually want to associate with. So what we're looking at now is the list of the largest daily changes in the Nasdaq history for up days. Okay, so what we find is the second best day in the history of the Nasdaq came yesterday, right? 12+% move. Now the best day in Nasdaq history was January 3rd, 2001. Now, the question is, was that the bottom of the market, right? So let's go ahead and take a peek here. And what we find is absolutely not. Absolutely not. The fact is, 9 months later, the Nasdaq was far lower. You know, at that particular time, Nasdaq was around 2,500, and here it went down to 1,500. Now, I also love to look at the Nasdaq from back in that time range, just because, to be quite frank with you guys, the Nasdaq was a joke back then. The Nasdaq was a speculative hot mess. It's not the Nasdaq it is 25 years later. No, no, no. The Nasdaq of nowadays is built with a bunch of massive beast companies that are insanely profitable, great margins, recurring revenue streams, you know, the strongest of the strongest companies in the world. The Nasdaq back in 2000, 2001 was not that. It was a speculative mania, like, you know, a la like a lot of crypto related stuff nowadays, right? Where it's like, oh, it's going to be big someday. A lot of people are going to use this token, blah, blah, blah. But it wasn't like all proven out yet, right? So that's the Nasdaq back then. But the moral of the story is here, you had that massive upward day and you still ended up going down quite a bit after that, right? The next biggest obviously was yesterday. Then from there, we had some incredible dates here, right? We already looked at the 2000, 2001 kind of time frame, so we don't need to look at that. So you can look at 2008, right? October 13th, 2008, Nasdaq had its third best day ever. And the fifth best day in the history of the Nasdaq was right here, October 28th, 2008. Nasdaq was up 9.5%. So what about in this situation? Well, that's basically where the market was at that particular time. Let's call it 1700 range on the Nasdaq. And ultimately, Nasdaq did go down. Went down to, at the lows, you know, we can call it in the 1200 to 1300 range, right? Now, keep in mind, it was only down at those ranges for a very short amount of time, kind of in that November 2008 timeframe, and then around March. So it wasn't like it was that whole time, because even here, Nasdaq's kind of 1500. But the moral of the story is here. On those days, it didn't mean like you were at the exact bottom, right? Many of the biggest rallies you'll ever see in stock market history are during bear markets. It doesn't mean you reach the bottom on the market, okay? So the moral of the story is you see a day like yesterday, people are saying that's the bottom. Doesn't mean it's the bottom. Could be, but it doesn't necessarily mean that at all, just to be quite frank. We could easily go down and actually create new lower lows. And it's very disheartening for a lot of investors that assumed we were at the bottom or got very emotional about it. Now, next up here, very important I show you this. This shows you if you just miss, because some people, when you're in a market like this, they start thinking they can play a timing game. They start saying, oh, I'm going to buy in at this time, get out this time. So what happens if you just miss a few of the best days in the market, right? Because we know you're not going to be able to time this out perfectly and call the market on a day in, day out basis. No one can call the market on a day in, day out basis, ever. No AI can do that. No one's sophisticated enough to do that, to be able to say, tomorrow the stock market's going up. The next day it's going down. The next day it's going down. The next day it's going up. No one can do that. No AI can do that. No one will ever be able to do that, to be quite frank, okay? So let's say you're not intelligent enough to realize that, right? And you think you can call the market and get in and get out and all that stuff, okay? Look at this. If you just stay fully invested in the market over time, right, you go to $224,000, right? Growth of $10,000 from 1995 to 2024. Now, if you just miss the 10 best days, remember, that's over, several decades, 2 decades, right? 3 decades. If you just miss the 10 best days, you have less than half the amount of money, $102,000, 54% less. And that's if you just miss the 10 best days in 3 decades. That's insane. That's insane. No, imagine you miss the 20 best days. Now you have 73% less money. 73% less money from just missing the best 20 days over that time period. If you miss the best 30 days, 83% less. The moral of the story is you got to stay invested in the market. Anybody that ever tries to preach against you is preaching against mathematics. They're preaching against statistics. Like, it's just ridiculous. It's ridiculous. And it would be one thing if, like, there was some investor that became like, $100 billion net worth, and they were the one outcast that like, I could always see where the market was going short term, and I was in the market, out of the market. But that's never existed. That's never happened. That's never happened. There's not one investor in history, trader we should call him, that could get in and out of the market and made billions of dollars doing that. Not one. Not one. If you want to say, well, there was this hedge fund guy and he made a lot of money and sometimes he gets in and out of the market. That's sometimes. But I guarantee you the majority of the money he made was from just holding stocks and them going up over time. And from taking the 2 and 20. So there's no one that ever got some multi-billion-dollar net worth from trading in and out of the market all the time. It doesn't exist. They get rich from actually just holding great companies over time. That's how they made the majority of their gains. And from the 2 and 20 they take. And that's just facts. There's no debating that. There's not like a comeback from that. There's no debate. That's factual. And the same thing with what I just showed you. That's factual. It's not opinion. There's no argument to be made here. And so, if you want to argue against math, 2 plus 2 doesn't equal 4, you can do that. But what are you in that situation? It's just, okay.